Most people think institutional digital asset adoption happens like a retail exchange listing. They think a piece of legislation passes and trillions of dollars instantly cross public ledgers. A foreign central bank alters its interest rate and capital immediately flows into crypto. A global clearinghouse announces an integration and retail volume triggers an overnight price explosion. And foreign banking consortia are preparing a single day flip switch to completely replace fiat networks. That mental model is incomplete. The primary driver of institutional asset integration is not public sentiment or market hype. It is clear capital Tier 1 compliance, rigorous counterparty risk underwriting, and macroeconomic liquidity availability. Nowhere is this clearer than in the current matrix of global financial catalysts surrounding the digital asset ecosystem. To a retail observer, a string of major global news items sounds like an immediate formula for compounding price appreciation. But to a commercial risk manager or a central bank auditor, these catalysts represent complex shifts in global structural plumbing. Quietly, consistently, and systematically, institutional infrastructure moves based on clearinghouse clearing guidelines, not retail timelines. This audit exists to explain why. Not as a speculative price forecast, not as a validation of internet chart echo chambers, but as a cold, data-driven systems breakdown of how four massive global catalysts actually interface with digital liquidity corridors. Before we go further, the required disclaimer: this video is for educational purposes only. Nothing in this video should be interpreted as financial, investment, or trading advice. We are not making price predictions, and we are not recommending buying, selling, or holding any asset. Markets move based on structure, incentives, and liquidity conditions, and those dynamics can change. Any investment decision carries risk and depends on factors well beyond the scope of a single video. Always conduct your own research, consult appropriate professionals when necessary, and make decisions based on your own circumstances and risk tolerance. With that context established, this is a reality audit, an objective assessment of structural friction and structural alignment. An audit does not ask what speculative markets want to happen tomorrow morning. It asks what underlying operational dependencies exist, what macro liquidity constraints are binding, what timelines are dictated by legacy enterprise integration. This audit is evidence-based, not narrative-based. Let us begin by dissecting the dominant retail myth regarding international banking volume, specifically Japan's multi-trillion-dollar monetary baseline. The common public narrative states that Japanese banking networks are preparing to dump an entire municipal budget directly onto public ledger protocols simultaneously. This widespread assumption stems from a profound scale distortion, often confusing domestic Japanese yen denominations with raw US dollar liquidity. The true systemic reality is far more compelling, yet it requires a complete departure from retail timeline illusions. Japanese financial giants and regional banking consortia are actively engineering cross-border payment corridors to mitigate reliance on the legacy Western correspondent banking grid. They are building multi-layered settlement rails that utilize digital assets as neutral, low-friction liquidity bridging mechanisms. However, a Tier 1 financial institution cannot simply expose its domestic deposit base to raw, unmitigated public ledger volatility. Instead, they operate through permissioned liquidity routers and highly regulated institutional access points. The capital does not flood the network in a singular public market speculative wave. It accumulates programmatically as automated clearinghouses transition their back-end settlement messaging from legacy financial rails over to decentralized network standards. This structural transition directly collides with an overlooked global macroeconomic force: the Bank of Japan's monetary policy. While retail commentators ignore central bank interest rate adjustments to chase minor regulatory headlines, institutional risk desks do the exact opposite. When the Bank of Japan tightens monetary policy by raising interest rates, it sends a profound shockwave through the global financial perimeter. For decades, international hedge funds and megacorporations relied heavily on the yen carry trade. They borrowed cheap, low-interest liquidity out of Japan and deployed that capital into higher-yielding speculative assets across Western markets. When a central bank raises interest rates, that cheap leverage contracts rapidly. As borrowing costs tick upward, global institutional liquidity tightens, forcing a defensive reduction of risk across all highly speculative or unhedged financial instruments. Understanding this macro relationship is critical to understanding near term digital asset price action. Asset price appreciation within an institutional framework is not a psychological reaction to a positive news event. It is an explicit mathematical byproduct of structural liquidity availability, balance sheet capacity, and regulatory capital compliance. If global macro conditions are tightening due to major central bank adjustments, the timeline for institutional deployment naturally shifts toward risk mitigated structures. This brings us directly to the operational mechanics of the Depository Trust and Clearing Corporation, or DTCC. The internet is filled with claims that the DTCC is opening a massive market perimeter that will immediately force trillions of dollars in traditional equities onto a public ledger over the weekend. This is an operational impossibility for a global systemically important clearinghouse. The DTCC is indeed executing groundbreaking advancements in the tokenization of real-world assets. They are testing permission data environments and digital credentialing infrastructure to streamline collateral management and reduce settlement times. But the true reality audit reveals that clearinghouses deploy infrastructure in highly controlled, multi-year sandboxed validation phases. An institutional participant requires weeks of simulation testing simply to verify that a tokenized money market fund can serve as eligible margin collateral without introducing overnight settlement risk. The integration is absolutely real, and it establishes a massive systemic validation baseline for the utility of assets like XRP, but it develops through precise, phased enterprise onboarding protocols rather than sudden public exchange volume. The legal foundation for this entire institutional transformation rests heavily on the domestic stablecoin frameworks being established by bills like the Clarity Act. As decoded in our prior audit, the intense banking lobby resistance to stablecoin frameworks is a fight over low-cost liabilities. Traditional commercial banks know that if a clean stablecoin regulatory framework passes, non-bank financial infrastructure can operate as a narrow bank. This allows them to issue digital assets backed 100% by central bank reserves, completely bypassing traditional commercial bank deposit structures. For an enterprise asset like XRP, this legislation is the ultimate structural gateway. A clear stablecoin framework provides the formal regulatory perimeter that Tier 1 custody giants and liquidity routers need to interface safely with open network protocols. It bridges the gap between private bank ledgers and public neutral liquidity networks. When you map all four of these catalysts together, the structural picture becomes completely clear. The catalysts are not isolated events designed to fuel short-term retail trading positions. They are interconnected components of a major structural overhaul of the global financial plumbing system. The DTCC provides the core asset tokenization architecture. The Clarity Act establishes the legal boundaries for digital dollar liabilities. Japanese banking consortia provide the real-world cross-border transactional demand. And central bank monetary policy dictates the overall cost and velocity of the capital flowing through these new corridors. Retail traders consistently fail to realize that infrastructure assets do not print parabolic price charts based on surface-level speculative news. They accumulate utility value as commercial entities phase out old settlement mechanisms to capture back-end capital efficiency. If you filter your market thesis through daily internet headlines, you will remain perpetually frustrated by flat or divergent price movements. But if you audit the balance sheet mechanics, you see that the plumbing is being steadily re-engineered to operate on neutral, disintermediated infrastructure. Your objective as a participant in this ecosystem is to monitor the systemic checkpoints, not the retail sentiment. Stop expecting a legacy financial system to transform via an instantaneous overnight switch. Track how Tier 1 institutions align their risk models with emerging regulatory perimeters. When you recognize that macro liquidity and clearinghouse rules control the timeline, the retail mythology falls away, leaving only rational institutional execution. Thanks for watching.